Hello, everybody. Welcome to today's live training. I'm Rachel Neighbors. With me today, we have a very special guest, Eric Restrepo, a life insurance expert. Today, we're going to dig into life insurance, really kind of a primer, Life Insurance 101. What is it? What are the different types of policies that you can get? Why should you consider having life insurance in your investment portfolio as a part of your estate plan? So we have a lot of really interesting stuff that we're going to get into. If you've been on trainings with us before, you know how it goes in the beginning. Let us know that you can see us and that you can hear us. On this side of your screen, you should have a chat bar. Go ahead and type in your name and where you're joining us from. And then just let us know you can see and hear us. The picture looks clear and that the audio is coming through clear as well. Thank you so much for being with us here. Gary, Carmen, David, Danthu, it's really wonderful to have you. I know sometimes there can be a little bit of a delay. Yeah, hi, G, thank you. Sometimes there can be a little bit of a delay. So just write in your name and where you're joining us from. Hey, Don, Charles. All right. People starting to flow in. That's great. And we're so glad to have you with us on these trainings. It's really important, especially as a self-directed investor, that you know what your options are and that you know what types of investments are available to you. So that's exactly why we do these trainings. We want to make sure that you have powerful tools in your tool belt that can help you really be in a position to prosper and live well through not just your retirement, but your entire life. And in today's training, make sure that your heirs are also well prepared and well cared for too. So, and thank you, Stacy, Jim, John. Okay, so welcome, Eric. Thank you so much for being with us.
Yeah, thank you so much for having me. I really appreciate it.
Yeah, absolutely. And as we're getting started here, Eric, I'm curious, you've been in the financial services industry for going on a decade now. Why life insurance? What was it that sparked your interest in wanting to really be an expert in life insurance?
Yeah, no, great question. And I mean, it's really kind of a long story, but I'll give you the short version. I came out of college pre-Great Recession, pre-2008. I set that precursor because, that is such a monumental event in my life. And I'm sure for a lot of folks in this group too, that, I went into a corporate job. I was working in that job and essentially really, I wasn't affected necessarily. I didn't lose my job, but I saw just how negatively affected many people around me were. Right. And so, man, I really took a personal ownership of that. And I mean, I had an economics degree from UC Davis and basically really just wanted to dive in and understand finance and the global economy really and get deep into it and figure things out because, man, like it was so impactful in terms of what happened to folks at that time. Right. And so, I actually had some uncles that were in the business. They were financial advisors as well as my grandfather. And so I thought, well, let me just go to the source. Let me go to, the financial experts. And, so I ended up interviewing at several different financial firms, Merrill Lynch, all the big ones. And I took a job at Morgan Stanley. And, much to my surprise, when I was hoping to get really like the best financial strategies, tools, training, unfortunately, what I found was that I got a lot more talk about how to bring in, all of my family and friends' money, and it was really one of those things where, you're hoping to really like get all of the best tactics and all the best training, but really at the end of the day, it was mostly about how to bring money to the bank and then sell them other bank type products, right? And so it was pretty disappointing for me. I worked there for a short time, left and went independent and really set out on a course to really try to find out what were the best strategies, what were the best things for both, obviously for me, for my family. I care about obviously all those folks, but for my clients as well, right? And so it's been really like a long journey to that. I've read pretty much every financial book around, bought courses. I've invested in training all over the place. And even more recently, joined some of the most elite business and tax planning type masterminds to be able to just to gather really with the heart to just serve my clients better, right? And so it just turns out that life insurance plays a huge part when we talk about, planning for clients for the entire life cycle. And obviously I'll get into that a little bit more in the training, but it wasn't necessarily that I set out on the course to like be a life insurance expert. It just turned out that was a huge, huge piece of the puzzle for, most people that I talk to every day.
And I know it can bring people a lot of peace of mind. That's really what I hear the most when people talk about after they have their policy set up. There's a peace of mind. And I know that you have a presentation prepared for us, so you'll get into some of the benefits of different policies, be it, cash values or death benefits, just ways to take care of yourself during your life and ways to take care of your loved ones after you're gone. So that incredible peace of mind, I think it's really priceless for a lot of people. And especially absolutely. With what we've gone through this year, people want to have a bit of certainty because things are so up in the air.
Yeah. Oh yeah, definitely in the middle of a pandemic. I mean, having something in place that, heaven forbid, right? If something were to happen to you, that that 100% for sure your family's taken care of. I mean, it's kind of hard to put a price tag on that, right?
Absolutely. Well, and thank you everyone who I know is all, continuing to pour in. It's wonderful to have you here. Eric, I know you have a presentation that you've shared with us. Whenever you're ready, you can go ahead and share your screen and take us through that presentation so we can dig into Life Insurance 101.
Sure. Absolutely. Thanks, Rachel.
Yeah.
Let's see. All right. Can you see the screen okay?
Yep. Looks awesome.
Awesome. Perfect. So yeah, I've titled this presentation, Protecting Your Assets. Really, like Rachel said, Life Insurance 101. And the little picture really here is really what I've found is that real financial advice, true financial advice, is the intersection of your life and your money, right? It's not just about how do we amass the most money over here on a pile. It's really how do we think about planning for your entire life cycle, right? And so I'm going to get into that. But keep in mind, this is the 101 course. So if you guys like what you're hearing, if you learn a lot from this training, if you have other questions, be sure to let us know, because there may be future webinars where I dive deeper into other concepts about life insurance and other different structures in a little bit more depth. Okay. With that said, really, when we're looking, imagine yourself, right, when you're trying to figure out life insurance, like, how do I get this coverage? What do I do? For most folks, the source in our day and age is Google, right? We go there, and I'm sure all of you guys have had this experience, right? Where you go and you type something into the Google search bar and you're like, okay, life insurance. And all of a sudden, all these different links populate, right? One of them says, only buy this, don't buy that. The other one says, no, never buy that, buy this other one, right? And so there's all these voices clamoring for your attention. We have no problem having so much information, right? And so what do you do when that's the case, right? Well, in my opinion, really, you don't need more information. In my experience, in my time in this industry, you really just need the right plan of action acted on at the right time, which is to say you really need wisdom, right? So it's really that you just need those time-tested principles to be able to access and do the right thing at the right time, right? Really, and Gary Vaynerchuk said it best, our world really is abounding with information, right? And so if content is king, what he said is context is God, right? So we really do need that age-old wisdom. And so that's what we're going to set about to do. And so here, I already kind of shared a little bit of my background, but I graduated from UC Davis with a BA in economics. I was a college athlete, played golf in college, and was an All-American actually at one point in my career. I actually started out my career in a corporate job, left that to be an entrepreneur. My wife and I bought a small business, and at the same time, I went into the financial industry full force. I told you about being trained at Morgan Stanley. I've been an independent broker for the last 7.5 years. And now since then joined some other really elite mastermind groups where we hear from the top experts in tax and business planning. And also obviously really have cultivated this life insurance expertise over the years that's why I'm here talking to you guys today. Also, really the most important thing to me is my family is everything to me. So I've got my wife, Alex, of 13 years, and then I have 4 kids, Jeremy, age 8, James, age 5, and Isabel, age 4. And then we just had our newest one, Theodore, and he was born 3 months ago in the middle of a pandemic, right? Pretty wild. So again, I want to introduce this topic really from the standpoint of, hey, we all have biases, right? I always set this precursor in my presentations because unfortunately, out there in financial land, you hear a lot of stuff that ultimately it sounds like financial advice, but really it's financial marketing in disguise. And especially probably one of the worst things that I hear a lot of times is, I'm going to give you some unbiased financial advice. It's kind of like when you hear those news commentators saying, this is an unbiased news source, right? I basically say, if you hear that from anybody coming out of their mouth, run as fast as you can in the opposite direction, right? So really the goal here is for me to share a little bit about my biases and for you to evaluate, do my biases match your biases, right? And always, we should always be evaluating whether our biases are the most correct, right? So part of that is as the other side of it too, just to be always constantly looking at those things. So really looking at that, my core beliefs in terms of this presentation and the context I'm setting here is really, number one, human life in and of itself is deflationary in nature. And what I mean by that is that it's basically like my wife's grandfather used to say, once a man, twice a child, right? So we go from cradle to adult to grave. All of us are going to live and are going to die at some point. I know that's probably kind of a grave thing to say, but the reality is that is the human life cycle, right? And I mean, this is kind of a basic concept, right? But in today's age with, biotechnology, so many things where, it's important obviously to set the context here that all of us are human. We all are in this human experience together, but at the same time, we are finite, right? No one has come up with the way to extend life infinitely. So that's
this is a really important, I like that. Yeah. I saw the sneak peek of that next slide. This is a really important concept too, Eric. I'm really glad you brought this up. And you're right. Sometimes it can feel maybe a little uncomfortable to talk about this stuff, but we have to. Our families, our children, they deserve for us to have this conversation so that we can do the planning that's necessary to make sure that we and our families are taken care of.
Yeah. And it's interesting being, that most of us, I'm sure in this context are in Western cultures. And so there's really not as much talk about that in our culture for whatever reason. But that's what I find when I sit down with people is maybe they haven't thought that much about, their ultimate demise, right? That in reality, they will someday, they will come to an end, and maybe their kids will keep going or their spouse will keep going. But yeah, absolutely. It's super important to realize hey, we're all going to die one day. Right. And that's so critical. And then my kind of joke was unless you're Benjamin Button from that movie, I don't know if you guys saw that movie, but basically it's where he's born an old person and then he gets younger and younger as he gets
right
in chronological years. Yeah. So kind of a funny thing, but obviously none of us have that blessing, or well, maybe it's a curse. I'm not sure. Number two, really, we all go through these 3 main human financial economic phases, right? So we start out in accumulation phase where we're basically trading time for money. We're going out to work, or if we're an entrepreneur or a business owner, we're going out to build systems that help us to generate resources, right? The whole idea being that eventually we probably switch to distribution phase, number 2 phase, where our assets or our money is paying us to be able to live, right? And then if we're fortunate enough, maybe we accumulate beyond that And then we're thinking about transfer, right? How can we be able to not just transfer our wealth, maybe it's our expertise, but all of the things that we have gained in our lifetime to whether it's the next generation, our children, maybe to a business partner, maybe to, someone else, maybe a charity. But that's the idea. Those are really the three main phases, and all of us go through them. So it's just important to recognize that looking at where you are, what context do you sit in, and how does this fit into your financial picture at this moment, right? Number 3 is really kind of a basic one, but I just figured I'd put it in here. Really, for you and me, human connection is valuable, right? We have to kind of make that fundamental belief and agreement. Like, you probably have someone that you love, whether it's family, whether it's a spouse, whether it's a partner, a business partner maybe, or, but that's fundamental, right, to this conversation. I would say most people would obviously agree with that. They value their loved ones. Maybe they've had some squabbles, but for the most part, obviously we love our family, right? That's absolute. Number 4 really is that I believe, and this is something you can agree with or not, but you are the most valuable asset. Basically, your creativity, your gifts, your talents, your skills, and your abilities. We can talk about investments all day long and putting money into other people's ability to build companies and things like that. But really, in reality, protecting you as the most valuable life in your own life is extremely important. Number 5 really is what I said at the beginning. It's just that true financial advice is the intersection of your life and your money. Seems pretty simple, but you would be surprised that a lot of the mainstream financial advice is really geared toward just money management and building up the largest pile of assets that you can, without really a whole huge purpose of why and what you're trying to do with it, right? And so really that kind of brings us into like life insurance as the topic. I know that was kind of a lot to unpack, but I think it's important to set the context ahead of time, because really, like, life insurance at the end of the day, it's just the vehicle, right? No one really cares about necessarily life insurance. They care about what it can actually do for them. What can it actually provide for them, for their families? And that's so super important. So really, for this conversation, there's 4 parts to this story. Basically, what is life insurance? What are kind of some appropriate uses and purposes for non-business owners? So we are going to just talk mostly about personal today. I can get into other things, other concepts for business owners and things like that at a later date. Also, we're going to talk about types of life insurance and then pitfalls to beware when you are buying life insurance. Okay, so things to watch out for, things to make sure that if you're doing it, that you're doing it the right way and not getting taken. So really, what is life insurance, right? Let's start with the definition. So life insurance basically is an insurance that pays out a sum of money either on the death of the insured person or after a set period, okay? So essentially, you're trading an amount of money monthly, semi-annually, annually, for the benefit of having a death benefit pay out to some beneficiary, right? And so really, for a life insurance policy or a contract, it truly is a promise to pay, right? It's a contractual obligation by and the parties that are involved are the insurance company, you as the insured, you probably as the owner potentially, maybe there would be a different owner sometimes, and then the beneficiary who is going to actually receive that amount of money, right? And that's the basic 4 parties. Because it is a contract and a promise to pay, it is super important the type of company that you work with, that they're actually going to have the ability to pay that claim. They're actually going to be able to stand up through the course of time while you're paying them those premiums. Heaven forbid the worst does happen, they actually have the financial strength and stability to be able to pay when the time is needed, right? So that's super important. Also, really, when we're thinking about this life insurance conversation, how much life insurance do we really need, right? And there's a concept called human economic life value. Now, human economic life value is basically calculating the worth of a human life, which, for most folks, I mean, for me included, for my loved ones, I would say I'm pretty priceless, right? You can't put a price tag on a human life. There's no way to do that, right? Well, it turns out that some people in the insurance industry, go figure, they've figured out how to value different human lives. I read this article, it's pretty interesting. Basically, what it boils down to is that the way they kind of measure it, and this is obviously these are arguable ways, but it's truly interesting that governments have to make these decisions based on policy about how they spend their money based on the value of an individual human life. And so what it turns out to is, like, if you look at, like, for example, how many people die by auto accidents, if this company adds a particular safety feature that maybe costs an additional $100 per automobile, that eventually, basically what that boils down to is we can save one more life out of 1,000, for example. And maybe that ends up, if you do the calculation, that particular life that we just saved, that cost overall close to $10 million or $8 million. So it turns out about that. I mean, there's different numbers people are throwing out. Again, the point really being, you can't obviously put a real price on it. So how do you necessarily value a human life, right? But it turns out that there are some specific ways to do it. Common uses of it would be income replacement, right? Common ways to set a value would be to say, what is the economic value of this person? What are they bringing into their household, right? So in terms of what's their income currently and what is their income earning potential over the course of their working years. So looking at that and having at least like 10 or 12 times what your current income is. Sometimes people want to have more than that, but at least having that amount. There are also more complicated methods to do valuation. There's a capital needs analysis, which involves looking at your debts, looking at quite a few other factors, including college funding for kids, other things that you're considering when thinking about what is an appropriate amount of coverage to have, right? Also, a very common way to think about it in a more basic sense is just covering all of your debts. Just debt payoff, mortgage protection. That's a concept that people use with life insurance all the time. Another one is for final expenses or for funeral costs. Commonly, people do use life insurance as a way to pass money so that way nobody has to cover their funeral costs, right? Also, tax-free wealth transfer, right? So this is kind of what Rachel was talking about in terms of passing things on to your heirs. I find that a lot of folks, unfortunately, have saved money into tax-favored vehicles for themselves, but then what ends up happening is that they end up passing on their tax problem to their loved ones, and that's not very fun, right? So life insurance can be a way to pass money tax-free to your beneficiaries, right? Also, for some folks, if they're at that level, paying estate taxes can be used. Life insurance can be used to pay estate taxes. This could be particularly significant right now because of the potential changes in the Oval Office right now, right? We have an election coming up. Currently, the estate taxes are at a super high amount. They've never been this high, actually. They're like 11,400,000. But there's been talk in years past of dropping those all the way down to $1 million. So that kind of thing could affect a lot larger group of population, right? Especially if one party or the other gets into office, right? Also, charitable contributions. If you are looking to pass on things to a very, like, a favorite charity of yours, paying into a policy on a monthly basis absolutely can be a very, very solid way to pass that money on in a tax favored way. Also, looking at other common uses for permanent life insurance, and I'll get into kind of the differences of different types of insurance, but life insurance really as an asset and as property. And if you really look at and study the IRS code, which that's, if you want a way to fall asleep, there you go. But it's pretty interesting, actually, that life insurance is really similar in terms of the way that the IRS views it to like real estate and other property. Okay, there's actually similar types of laws where you can exchange things like kind for like kind, just like with real estate. And so it is treated like property, right? With these types of policies, you can actually diversify from traditional assets like stocks, bonds, mutual funds, real estate. Some people have actually come up with ways to basically create like a family bank to be able to pass on wealth from generation to generation, kind of almost like a waterfall effect. And I can get more into that at a later date. just so that you know that is possible. Also, a lot of times to provide educational funds for kids and for grandkids, right? Permanent life insurance obviously is certain to pay out. It's going to make sure that benefit will definitely 100% pass no matter what. So also funding a bequest, liquidity when you really, really need it most. And then another concept, which I probably won't be able to get too deep in today, but pension maximization, when people are thinking about taking their pension option, really what is the best option to take, and how can life insurance kind of play a part in maybe maximizing what they can take in terms of their pension. Okay, so these are all really important concepts to understand. The two types, and I'm not going to get super deep into those today, but let's talk about the two different main types. There really are, although you probably see online multiple different types, there's really only two main categories. Okay, there's term and there's permanent. Okay, and so term, really the way that I would say it is that basically you are renting your coverage for a certain period of time. Okay, there's two types typically of term. There is annual renewable term, which basically has a set cost just for that 1 year. And then you get to choose to renew it the next year with a little bit greater cost. Okay, that's something that's very temporary, but definitely it can be inexpensive. Okay, so it can be a good placeholder. Also, for the most part, what most people are probably familiar with is level term. So that's where you basically have a level death benefit. So a death benefit that stays the same for a certain period of time, and your monthly outlay or your monthly premium or your annual premium would stay the same for that period of time. So 10 years is common, 15, 20, sometimes 25 or 30 as well. And then another common type, or not so common, is decreasing term, where sometimes people want, if they have a mortgage, they want to have that term be able to go, the actual level, the coverage amount to actually decrease with maybe the debt that they owe. Less common these days, but it's definitely something that is available as well. Then there is permanent, right? And in permanent, there's kind of, it's 5 different types. So there's whole life, which is the most standard type that's been around for the longest, been around really before 1900s, probably more than like 150 years. There's participating, non-participating. Participating, what that really means is that as a policyholder, you get to participate in the company's profits. You actually get dividends that are paid to your policy, or you can receive them as cash. So that is probably the most standard permanent coverage. It's been around the longest and has the longest track record. There are newer types that have come in, more like these came in about in the 1980s as competitors to whole life. And basically the idea was Wall Street said, we can do better than what whole life has done over the years. We can make it cheaper. We can manage the money better. And so all of these are various strategies to have life insurance as a permanent benefit, but be able to have the cash value account or the value that's in there managed in a different way than the traditional whole life route. Universal life came out first. It was basically a set interest rate that you got in your policy. And then, what they realized was, like, as interest rates changed, sometimes those policies didn't play out super, super awesome. Then they came out with index universal life, which is where you get to actually participate in a stock, like a S&P 500 based index. To be able to hopefully,
is that indexed to the stock market, kind of like an annuity would be an indexed, like an indexed fixed index annuity?
Yes, exactly. No, it's exactly like that. So you'd have your cash account would be able to, you typically have like a floor interest rate, so you can never lose value in that cash account. But you also get the potential of growth up to a certain cap. So you don't get typically uncapped growth, but typically the caps are right around 10 to 12, sometimes 14%. So you can participate in a pretty decent upside if the markets do improve, right, on that particular year. So those have been definitely really popular since they came out. Probably outside of whole life, that's probably the most popular option in terms of permanent coverage. And then guaranteed universal life is really a way to have the permanent benefits. It's kind of like a low cost whole life. That's how I would explain it. They're able to offer permanent coverages with very little cash buildup in the policy. But it's kind of like it's like having a a term coverage that goes all the way to the end of your life, but really with no ability to access any of the accumulated cash in the policy. Okay. And then the other type really is a variable universal life. This is where you're actually, so there's two components to a permanent policy. There's the death benefit, and then there's the cash value component. In this one, the cash value component is actually invested in actual mutual funds and stock related investments. And a lot of times it's a mixture, and you can actually change the allocations. So that is another type of policy. There's been speculation. I know this is a lot of folks in this group maybe have heard or enjoy investing in Bitcoin and other cryptocurrencies. There's been speculation it would probably be that kind of structure where someone might be able to put like a Bitcoin investment in their life insurance policy. Okay. So, and then the other part is like, a lot of people ask me, do I have to die to use the benefit, right? And if you haven't really looked into life insurance in a while, typically the case was a long time ago, right, that you just basically the only way you would get paid is if something happened to you where you passed away entirely, and it would go to your beneficiary. With these newer policies, you actually have you have living benefits, right? So things that can actually help provide for you during your lifetime. So whether that's a chronic illness, so a lot of times these can actually be a replacement for long-term care coverage. So long-term care need in terms of that, because of the way that our system works with Medicare, it doesn't cover for those long-term needs, right? Yeah, Medicare is designed to cover for a short stay in a hospital, but if you needed extended care, obviously that's when people buy long-term care coverage. But a good life insurance policy can actually kind of do both things at once, right? So you can have that death benefit, and then also have the protection of, hey, like if something happens to me during my life, then I'm also covered. So what happens is basically you can advance a portion of your death benefit early, okay? Instead of having to wait until, passing away to receive that benefit, you can actually take a portion of the death benefit, a lot of times quite substantial amount. Also for critical illness, so something like a heart attack, cancer, stroke, these are triggering conditions that would allow you to also advance your death benefit early.
And this seems like it could probably take some of the pressure off of economically off of your immediate family. And that would be one use case of this, right?
Exactly. Yeah, no, exactly. And yeah, it's kind of the idea of like, if one of those triggering events happens, right, a lot of people end up having to drain assets that maybe they didn't want to have to drain, right? So this is just another way to plan ahead for that risk and really transfer that risk away from yourself to a really qualified, financial institution that would then be able to step in the event that were to happen. It can be a pretty inexpensive way to do it because it is part of that life insurance policy. Because what happens with long-term care policies, it's kind of usually a use it or lose it type of thing. So if you don't end up having a long-term care event, then you've paid all these premiums in, and then you don't get any benefit. With this, because it's lumped in with your life insurance, you basically get the death benefit regardless. And if you need it during your lifetime, you actually can use that as well, right? So yeah, it's definitely a really, really nice feature to have. Also, terminal illness benefits is super common, right? Like a serious illness, like a cancer, end-stage renal disease, things like these. It's that really getting that cash payment ahead of time. It really helps in that kind of a situation, right?
Are these living benefits, Eric, are these a part of the whole life policy, the universal life policy, or can they potentially be both depending on what, in having a discussion with you, for example, can they potentially be built into both as long as it's a permanent plan, or is it like this is only available for whole life policies?
No, yeah, this actually, and believe it or not, you actually can get these as a part of a term policy too. Okay. So it's not just permanent coverage, and it's not just one particular type. There's a lot of companies that offer, whether it's universal life or whether it's index universal life or whether it's whole life. But yes, you can definitely find these in any kind of a coverage at this point in time. Yeah, it depends on the company, and it sometimes does depend on the jurisdiction that you live in. So what state you live in. if some of these additional benefits are offered. Strangely enough, states have different rules about that. But yeah, that's definitely something that is a possibility for all the different types that I talked about. Good question. And then now I'm just going to kind of jump into just pitfalls really to be aware of. This is stuff that I've seen just from, being in the industry for so long and talking to so many people about, what their experiences have been and also just from personal experience. But one of the main ones is non-medical or simplified issue insurance. And what that basically is, for the longest time, if you were going to get coverage from a life insurance company, a reputable company, you have to typically submit to a paramedical exam where they come out, they take your blood and urine, they basically evaluate you as an underwriting risk to the company, right? Well, some companies have gone a different direction where, and it's in a good effort. It's trying to basically help the consumer to get their coverage faster a lot of times. And definitely in some situations, in some companies, I would say it's okay. I would just watch out. There are some companies that are charging you quite a bit higher rate for that quick access, right? And so that can be something to watch out for, something to weigh and to consider. So just be aware that those simplified issue can have kind of a double-edged sword. It can let you get the coverage quickly, but then maybe you end up paying double, triple, even potentially quadruple of what you could for a policy that was fully underwritten. Okay. Also, agents peddling accident coverage, telling you it's life insurance. That's kind of a basic one, but I have seen that out there. People think we pull out their policy, and fortunately, because it's been sitting in the drawer for 5, 10, 15, 20 years, they forgot about it and now they pull it out. And unfortunately, when they bought it, they didn't really read the fine print, and it's actually not a real true, believe it or not, these are not like crazy people. These are just normal people that thought they had life insurance that had actually accidental coverage. And what accidental coverage is it basically just covers you if you have an accidental death. It doesn't cover you for the main ways that people die in our country. That's by sickness, right? Heart attack, stroke, cancer are kind of the main killers, right? And so imagine paying into a policy all these years and then something happens and all of a sudden you try to go get the money from the company and they won't pay because of the fact that it wasn't actually life insurance. So that's super bad. Also getting coverage that doesn't anticipate or have flexibility to account for your future needs. So too short a term, not enough coverage, not convertible or flexible. So really there's kind of a lot to consider when you think about both your needs now and in the future. Also, another one is really choosing a low rated company, really without investigating or kind of knowing or having awareness of, there's actually ratings agencies that look at these companies' financials and decide, how well rated are these companies? How strong financially are they? How able are they to pay the claims if, heaven forbid, something were to happen, right? Also, relying only on group coverage. I do see this quite a bit. Folks, are working at a company. They get coverage typically for a very low cost or maybe no cost. And I love the fact that they do have some coverage, but unfortunately that typically does not go with you. It's not transportable usually. And so what happens is you lose your job or you leave your job and now you're maybe older and now you can't get the coverage that you wanted or maybe at the rate that you wanted to get it at. So that can be an issue that I've run into in the past, right? Also, let's see. Yeah, just not getting coverage. Oh, this is really kind of a basic one, but a lot of people think because I have a spouse, maybe that stays at home with the kids and has the job of raising the family, that I don't need to get any coverage for that person, right? But in reality, when we actually do the analysis and we look at it, the amount of economic value that person is bringing into the household, although they're not working a job where there is an actual salary coming in, if you were to try to replace that person, with other people doing the childcare, doing the laundry, doing the dishes, doing all the errands, that would be quite a large amount of money, right? And so I see that a lot is people compromise a little bit on, and sometimes if it's an issue of cost, yes, I understand. But at the same time, think about the long-term ramification of that. If something were to happen to them, how would that affect your family, right? You'd have to figure out how to actually replace that person, not just from an emotional standpoint, but also just the practical things of actually doing for your family.
The day-to-day.
Exactly. And then really procrastinating is a big one, like, waiting longer, like we talked about at the beginning. At least me, none of us are getting younger, right? So really and unfortunately in the insurance world, as you get older, the rates do tend to go up with age, right? And so that's definitely something to be aware of. Also, typically, sometimes buying the cheapest policy or focusing only on price, choosing the wrong type of life insurance, like picking term when you should have picked permanent for the purposes that you need it for. Also, sometimes I see this naming a minor as a beneficiary. That can be an issue. And this is stuff that really, with the policy review, just looking over things on a regular basis. I always do reviews with my clients at least annually, to make sure that there hasn't been anything that's changed in their financial life to where we need to make any adjustments to their policy, right? Also, another really big one is keeping your policy a secret, not telling anybody about it, because really that's the whole purpose is, right, to protect your loved ones. And so think about that, is if you've paid into this policy, nobody really knows about it, or maybe they sort of do, but they don't know where it is. And then it comes time something happens to you, and then you don't really have a plan. Like, no one knows where it's at, because if you have ever gone through a death, which I personally have, we lost my father-in-law, you actually have to file claims for these things. It doesn't just happen automatically. You actually have to send in paperwork to be able to receive that money, right? And so having a plan, having a procedure, and having people that are aware of it is super important. And again, similar, forgetting to update your beneficiaries or wrongly assigning them. That's another really big one. You got to make sure that obviously you're updating your beneficiaries regularly, and they're the people that you want to receive that benefit, right?
We've had clients go through this in the case of marriage and divorce.
Mm-hmm. Yep. That can be a big one where you just kind of get in the middle of the, that fray of that whole situation, and you forget, like, oh yeah, the life insurance, and then, something happens, right? And that can be definitely a really big one. Also, with permanent life insurance, borrowing too much from your policy without any plan how you're going to pay it back, that can be detrimental, because it can actually potentially lapse or cancel your policy, which then it's not actually doing the job that it was designed to do, right? Also, sometimes not blending coverages. Sometimes it makes sense to have some term coverage and some permanent for different purposes, right? And so people get stuck in this mindset, I only have to buy term, or I only have to buy permanent. And well, there's a lot of times where we can concoct or build a plan that makes sense with a combination of both, right? Also, not taking advantage of cash value policies that you may already have. Maybe you have an old policy that you've had for a long time. Maybe it doesn't have all those updated living benefits and other things, and you maybe want to get those new coverages. Well, there's a way to actually, in a tax-free way, to actually transfer that value into a new contract. And a lot of people kind of just forget, leave that old one alone. They don't think about, well, how can we actually build this into like a unified strategy that actually makes sense all together, right? Also, setting up the policy improperly. Really, that's a big one. Unfortunately, in the life insurance industry and in the financial industry in general, there is quite a bit of cycling of people coming in and out, right? New agents, new advisors coming in. Maybe they're there for like a year. Maybe they're there for 3 or 4 years, but there's a high failure rate. And so unfortunately, because of that, they're probably not getting educated about how to set things up properly. And especially with a permanent life insurance policy, there can be really, really really not good ways to set it up for the consumer, right? Basically, the agent can set it up to where it benefits them more than the actual person that needs the policy to be operating or working in the way they really want it to work, right? And so it's super important that you work with a really trustworthy person that's been around for a long time, that understands these things and isn't out for their own gain, really, right? So that there's because of the commission breath that people have sometimes in our industry, They're just out to get the next deal. Unfortunately, they tend to do things that aren't necessarily the best for the consumer. So make sure that you look at that and make sure that your policy is set up the way that you want it to be set up. Also, not taking advantage of tax-free growth. So in a lot of those permanent policies, it can actually be a way to accumulate money on a tax-preferred basis. So after tax, kind of like a supercharged Roth IRA, if you set it up correctly, it can be a way to actually create an additional source of income in retirement, or a way to just accumulate tax-free money for yourself. Also, really not looking at, not considering all the risks with your plan. And really the risk of dying early, right? And so that's kind of a basic one, is like you're doing all this financial planning, you're looking at all these other, investment options, but then you're not thinking of this pretty major risk that we all have, that we walk around every day, like we talked about at the beginning, like we're all going to pass away. So just looking at that as a portion or as a piece of your financial plan is super important. And that's really all that I have for today. I think at this point, Rachel, if it's okay with you, we could open it up for any questions that people have. I know that was probably a lot to cover. That was just the life insurance 101. If people have specific questions, maybe in the future we can do a specific training on, those other concerns. But I just want to get, and this, for some people, this may have been very basic, but for others, really, like, maybe they haven't considered these things, right? So, but yes, thanks so much for having me. I really appreciate it.
Oh my gosh, absolutely. I know we have several questions that have come in, and guys, if your head is spinning a little bit, because there's a lot of variables, right, in selecting the right policy. If you're going to do, like you said, permanent versus term. If you're doing permanent, is it whole life? Is it universal? Is it indexed universal? Is it guaranteed universal? Is it variable? There's a lot of factors to consider, and I mean, I think you would agree that life insurance policies are probably one of the most individualized investments you can probably make.
Yeah, it's definitely very personal. That's for sure.
Sure. Because there's so many variables for your own individual situation. So for those of you that are on the training now, if you have questions or you would like to discuss this in depth with Eric, we have a button right in the bottom. I think it's right there, right in the bottom of the page here. It will take you to a short intake form. Eric has some questions that he'd like you to answer, just a little bit of background about you, and then he'll reach out to you and discuss what types of policies or what objectives might be helpful to move towards. But I do want to we have some questions here. So the first question comes from Bijan. Can we watch this webinar later as a recorded form? Absolutely. I know that we covered a lot of information, Bijan. We will have the replay available for you as long as you're registered, and you are, since you're here, you will get a copy of this webinar replay. And that way you can, go over the training again. And I know even for me, when you were going over some of those pitfalls, it started bringing up other questions. So I think having an opportunity to watch the training again is going to be really helpful to kind of dig into the nuts and bolts. Okay. The next question comes from G. G asks, do you recommend using a permanent life policy? Excuse me. Do you recommend using a permanent life policy as a place to keep excess cash for tax benefits?
Yeah, for some folks that can be obviously, like Rachel said, I would always put the precursor. These are very individual conversations, but
this is not tax advice, people.
Yeah, that's not tax advice, but yes, definitely life insurance, especially in this environment with Social Security, Medicare, Medicaid, all these unfunded liabilities, plus our government debt being at the levels that it's at. It is ripe. One of the ways that governments tend to get revenue, right, is to increase taxes. And so, yes, when they're thinking about vehicles for after-tax growth, really there's only a few limited types of vehicles, right? There's Roth IRAs and Roth 401ks and other types of Roth vehicles. And then outside of that, because there are some limitations around how much you can accumulate on an annual basis, life insurance actually plays into a large part of that type of planning. And so, yes, absolutely for who it's right for, absolutely that is a way to accumulate after-tax monies to be able to distribute to yourself later on for retirement, the supplemental retirement income. Obviously, you wouldn't probably want to build up a lot of cash in there if it's mainly for the benefit of passing it on to heirs. But again, those conversations are very individual, and the balance of accumulation versus asset transfer is something that we talk about with our clients every day.
Awesome. Thank you. The next question also comes from G. G asks, what about loans versus withdrawals if you need the cash?
Yeah, really good question. With that the same type of structure that was asked before, so the permanent policy where you are accumulating cash in there, typically most of the times we're going to do withdrawals up until, if we're talking about using it for supplementing income, typically we're going to take withdrawals. This is what I recommend to clients that are doing this, is to take withdrawals up until the amount that they have contributed. To the amount that they've contributed, because of the fact that if they do it beyond that, then there actually are tax implications of that withdrawal. So if you take it out of the growth, then you actually have to pay tax on that gain in your policy. So after the point that you reach all the money that you've put in, then I recommend taking preferred loans against your balance, right? And a lot of people get the thought that they're actually taking loans from their own policy, but what actually happens mechanically there is that you actually take a loan from the insurance company's general account using your cash value as collateral, okay? A lot of insurance agents out there think that you're getting a loan from your own account, but actually it's a loan from the general account of the insurance company with your account as the collateral. So I don't recommend that typically to start off with. If we can, we start to do with withdrawals, and then we move to those loans.
Can you, just as a follow-up question, can you touch base on a little bit about the loans? I know about 401k loans. So for example, I can take out an X number of dollars or a percentage of the cash value that I have in my 401k. I have 5 years to pay it back, the interest, principal, et cetera. Is that a standard repayment period for when you're taking a loan from a life insurance policy? Does it change from policy to policy or company to company? How is the interest rate set? I know I sort of threw like 6 questions at you, but
yeah, no, good
can
question.
You tell us a little bit about sort of the loan parameters?
It's going to really depend on the type of permanent policy. I would just start out by saying that. If we're talking about whole life, there are actually 2 types of whole life insurance companies out there. There's direct recognition whole life companies, and there's non-direct recognition. And this probably would be on another training, but basically the direct recognition companies, when you take a loan out, that money is actually the money that you have on, or that's on collateral for the loan, that actually gets moved to another account where it does not get to accumulate the dividend on that portion, that balance, right?
The part that's loaned out.
Yeah, but with that type of structure, you typically have a fixed rate loan. A lot of times the rate is maybe a little bit higher than the non-direct recognition companies, but it can be valuable in that you have a fixed rate, right? You're not concerned about that rate varying throughout time. The other type is the non-direct recognition. And that is the type where they actually continue to accumulate a dividend on your cash balance, regardless of if you have a loan outstanding. The trade-off there, though, is that they actually basically they have the interest rate be variable. The typical variable rates are lower to start off with, and I will say they're not able to increase them beyond like a quarter point or a half a point a year. So it's not like they're going to be able to jump that up super fast, super quickly. But basically on balance, what they're really trying to do, and all these, especially with whole life, all these companies are really competing for the same pool of policyholders, right? So they want to show really strong dividends. And if you think about it, because those policyholders are all holders or contract holders, and they're basically essentially owners of that company, when one person has a loan out, that can affect the performance of the overall group of policies. So it's essentially really what it boils down to is different ways of accounting for those loans, right? One has a variable interest rate. The other one is a fixed rate, but you get to not have your balance be able to get the best interest rate on that. So, but they on balance, I think really they end up being, so it could be more of your preference, right? But at the end of the day, they kind of both do similar things. Does that make sense?
Yeah, absolutely. That's awesome. Thank you. And also just goes to show that, again, this topic is so individualized as far as what your needs are, what the policy is, direct recognition, non-direct recognition. So I would definitely encourage you guys, if you are considering adding life insurance into your portfolio, if you have questions about what policy might make sense for you, use that button right there and then connect with Eric so that you can go over your personal situation. Because as we're, discussing and discovering here, it's just so highly individualized. The next question we have comes from G. G, you've got a lot of really good questions. I hope you're going to fill out this form and chat with Eric, because you have a lot of really good questions here. Thank you. G says, do you evaluate current policies for recommendations or to assess if those current policies are best for the client? So can someone come to you if they already have life insurance policies?
Absolutely. Yeah, I know that's almost probably half of what I do every day is people come and they want to know, did I get the right thing? Did I get the best thing for me? Right. And that's a very honest and good question, because like I said earlier, there are, because of the way our industry works, where people come in, they cycle in and out. Maybe it was a family member that sold you a life insurance policy. Maybe it was a friend of a friend, but reality is that they probably haven't been in the industry maybe they've been in the industry for a long time. Even sometimes those folks don't necessarily, because they haven't focused on it, they don't really know the ins and outs of how to actually properly structure it. It's funny because the financial industry, you would assume because somebody maybe has the title financial advisor that they would know everything about all things finance, right? But it turns out that life insurance is actually a very particular thing that, not everybody focuses on it. If they're mostly spending most of their time managing money, maybe they don't really know a lot about life insurance. Maybe they've written one case that year, maybe they've written two, but you got to really know who you're talking to. And like I said in the beginning, really evaluate that person's overall experience level and their biases, right? And make sure that is actually matched up with you, right?
Definitely. So
yeah.
Then G, if you have some current policies that you would like to have an advisor review, sort of see if they are structured to your best interest and to your greatest benefit, then definitely click on that button so that you can connect with Eric and review those policies together. Our next question comes from CW. CW says, can a solo 401k invest in a term policy that has a third-party beneficiary, for example, to knock out debt incurred by a business for a spouse or a partner? That's a complicated one, CW. Remember, and I'll just jump in a little bit on the solo 401k piece. The IRS sets limits at what your 401k funds, how much of your 401k funds you're allowed to invest in. If I remember correctly, you can't use more than 25% of your cash value for a term policy and no more than 49% for your for a whole life policy. So I guess then let's assume, CW, that you're in those limits, that the 25% is being used towards this term policy. If we step back, Eric, do you have any thoughts about naming a third-party beneficiary to knock out a debt? Or is it maybe more beneficial to name a family member as the beneficiary and hope that they pay the debt off? Have you encountered something like that before?
Well, I think what we're usually looking at is there an insurable interest? And so that would be something to evaluate. Because you can't, I couldn't make, some guy down the street my beneficiary. So there has to be, whether it's a business interest or whether it's a familial relationship, there has to be some kind of insurable interest. And I'm happy to kind of go through what those different ones are. There's quite a long list. So I don't know that I could really spout them off the top of my head right now.
All here.
But yeah, no, that would be the thing that you'd have to evaluate with any kind of life insurance. The beneficiary has to have they have to have an insurable interest in that beneficiary, right? The insured does.
Perfect. So then, yeah, CW, I would say with this particular case, just to get into the particulars with Eric so that he can go over the insured interest of, available beneficiaries, definitely make sure you fill out that form so that you can dig into the specifics of your situation. Our next question comes from Jay. Jay says, okay, this is piggybacking sort of on the solo 401k. How can a QRP, that's a qualified retirement plan, or a solo 401k be used to buy insurance? Example, an indexed universal life or whole life. So there are those limits that the IRS sets, Jay. I know you're a solo 401k client of ours. You actually have in your solo 401k document package, a page that says life insurance policy. So make sure that you read through your life insurance policy because it's going to reflect what those IRS guidelines are as far as limits on what you're able to use for 401k money towards a policy.
Can I kind of add to that too?
Please do.
Yeah, outside of that, I mean, there is in the code section, there is a different structure that can be added to a solo 401k. And I don't know if we've actually talked about this, Rachel, before, but 401h, subsection 401h actually deals with fully insured defined benefit plans, which can be an additional way to put away money on a tax preferred basis. You do get a tax deduction in the current year. It can be a good addition to a solo 401k. And in those, there is definitely a precedence for putting life insurance into it. Actually, that's primarily with a fully insured defined benefit plan. Life insurance plays in quite often in those types of plans. And
especially with a high earner, wouldn't you say that that's also really valuable? Because with the solo 401k, I mean, it's an incredible tool. You can put in up to $57,000 per person per year, tax deductible. But we have some clients that are 7 and even 8-figure earners. For them, $57,000 in a tax deduction is really a drop in the bucket. So if you can add on something like these DB plans, that's defined benefit plans, some people are putting $200,000-$300,000 a year into these plans. There's more considerations, obviously, that you need to take into account because a defined benefit plan has all this actuarial tables because you need to be putting in the money so that you can take the money out as part of your pension, defining your benefit of being are able to receive that plan. But Eric, I know that maybe you've touched base on those 401hs with some other clients. So is that something that people could explore with you as well in a conversation?
Yeah, definitely. Yeah, we work with a really reputable third-party administrator for those, and yeah, absolutely happy to explore and see if that might be a fit for somebody. Obviously, like you said, it's going to be mostly reserved for those folks who are high earners. But yeah, absolutely, it's and the primary reason why people do it is for the tax benefit, right? Like because just like with your profit sharing portion of your solo 401k, you get an immediate tax deduction at the business level. So that means right off the top, you're saving 15.3%, right? But again, it has to fit for the situation. But yeah, I'm happy to answer any questions about that. I've done that a couple times for folks. Yep.
Cool. And Jay, I know that you recently established your solo 401k with us. You are allowed to have both a 401k, which is also known as a QRP or a qualified retirement plan. It's also known as a DC plan, which means defined contribution. It's okay to have a DC and a DB plan for the same business. So that is allowed, even if you have a solo 401k with us, especially if you're a high earner or you're looking to get more into something like a DB plan or the 401h vehicle, then definitely make sure you reach out to Eric so you guys can discuss a little bit more about your situation. Okay, we've got a couple more questions here, and then we'll wrap up for the day. So the next question comes from Bijan. Bijan says, what kind of life insurance premiums can people deduct on their tax returns?
Good question. I'm actually, that's a new one for me. I have not necessarily heard about that before. But
So this would
I can do
definitely
some
be,
research and let you
yeah,
know.
yeah, definitely. And this
Yeah.
would also be a question, Bijan, for your accountant. You know,
Yeah.
we always stress for our solo 401k clients that it's important that you have your team. So we're here to write your plan documents, do all the boring back office stuff with the IRS, make sure you guys have all these awesome trainings and things like that. You might have your life insurance expert on your team like Eric, and then you want to have your accountant or your CPA that's a part of your team as well. And your experts, your team of experts play well together. So if Eric is writing a policy for you, then you might then take that information to your accountant and go, hey, are there some premiums here? Where can I deduct them on the tax return? How much can I deduct them on the tax return? Then you might come to us and go, hey, I'm going to be doing these 401ks. Can you help me look at some contributions and let's figure out the tax deduction? So build that team of experts so that you have each person in their specific role. So Eric will look into this a little bit. He can get back to us, and Bijan, make sure you're also speaking with your accountant as well. Totally. Okay. Okay, G, I think this is more of a comment. So get your questions in. This is our last call for questions here. I think this is more of a comment from G. He says, I think it's important to note in response to Rachel's question that interest on a life insurance loan goes to the insurance company, where interest on a 401k loan goes to you. You're right about that, G. With a 401k, it's also, though, you're the one that's doing the work, right? So you're the one that's creating those promissory notes. You're the one that's keeping track of the loan repayment schedule. You're the plan administrator. So understandably, the interest and loan repayments are going to go, the principal and interest goes right back into your 401k. If you've got a life insurance company, essentially they're administering this loan. They're making sure that you're paying back on time. They're tabulating your loan repayments, calculating interest for you if it's a fixed rate, or I'm not sure if there is variable rate, but if there's a variable rate for loans from life insurance companies. So good to note that interest goes to the life insurance company. Mm-hmm. Okay, so last call for questions here, guys. Thank you so much, Eric, for joining us.
Of course. Thanks so much for having me.
Yeah, this is a topic that really blows my mind. I've been an investor for a long time, but I'll admit I'm definitely one of those people that was like, life insurance, that's so you get the big cash payout when you die. And that's really it. And I'm seeing that it's quite short-sighted. It's really short-sighted to just view it in that narrow vein, because there's a lot of very interesting tools and elements to policies that I'm sure you go through with people to really design something that's highly individualized, highly specialized for their needs, their outcomes, what they want to accomplish. And then there's a lot of different types of policies that are available to people depending on what their outcome is. So,
yeah, definitely. Yeah, there's a lot. There definitely is a lot of variability in there, and you're right. It's the kind of space that it begs to have an expert that helps you along in it, because really there is a lot to know. And even if you feel like you've learned it all, there's the companies are they're innovating on a regular basis. So there's new things coming out quite a bit. So.
Well, and one thing, G, I think it was your question that brought this up for me. For those of us that have policies already, every year, every few years, it's probably a good idea to reevaluate those policies to see if the ratings of the insurance company has changed or decreased at all, if that policy is still serving your needs the way that you want it to. If I have a permanent life policy that was whole life, maybe in certain economic situations, it would be in my benefit to look into something like an IUL policy. So even if you already have policies yourself, it's definitely worth, a second look, talking to an expert like Eric to review the policies that you have and make sure that you're really in the best position you can be.
Yeah. And I would say, just to piggyback on that too, is oftentimes if you evaluate and look at your current policy, maybe you have coverage in place already, and it can actually be converted into something else, right? So without going through the whole rigmarole of getting, underwriting done again. I sat with a client just the other day, and another person had tried to help them and had tried to sell them another plan. And unfortunately, like they didn't look at, hey, there's actually a privilege in this person's current contract that allows them to take what they've already done in the past. Essentially, a conversion, what that does is they're able to, the life insurance looks back when you did the underwriting, however many years ago it was, and you get the privilege of essentially going back in time and looking at your health back then, right? And so you think you're really going to get a better rating back in time if you try to travel back in time than you are going to get today, right?
Interesting.
So that's something to consider is like, hey, I may have coverage. Maybe it's time to look at converting it, right? So that's a huge one.
For sure. And these are just things that I think most of us that are not, life insurance experts, this is not what we do all day, every day. We wouldn't necessarily know to look for these types of things. So I really like that you're able to sort of have an eagle eye and look at old policies and see if they're still really, in the person's greatest benefit. So I think we had one more question sneak in here from G. G says, can you have a follow-up? Oh, this might be a follow-up training that we do, G, but he says, can you have a follow-up on using loans for arbitrage, as arbitrage for investing? That's probably going to be outside of the scope of what we'll cover on today's training, G. But Eric, I'm sort of keeping a tally in my head of, other trainings that we'd like to have you back on, because I think that there's a lot of different ways that people can use these policies. I do have one final question. Is there any age that's, because, we have solo 401k clients of all ages, all walks of life, and also neighbors group, email subscribers, people that are on this training, all different stages in their life. Is there any age that's maybe too young to start looking at life insurance? I'm assuming that someone is of legal age. They're at least age 18. If I have someone that's maybe 25 versus someone that's 30 versus someone that's 45 versus someone that's 60, should all of those people look at life insurance, or is it really that, you tell people to start looking after a certain age?
Yeah, that's a good question. I mean, it does depend a little bit on particulars of the situation, but generally, like if the person has family that would lose something by the loss of that person, then yeah, usually we look at some type of coverage in it. And you said even after 18, but sometimes parents take out policies on children too. That's not uncommon actually, where, it's just a reality. Like if something happens to somebody, there's bills, or there's things that come up, right? So I
actually have a specific, when you triggered that, because at first I was thinking, oh, you would probably never have it for someone that's under 18, but we actually have, it's 2020. So people are making money in all different ways. And this year we've seen, or the past maybe 2 years, we've seen a lot of young people, minors even, that are earning 6 and some of them 7-figure income on YouTube. And for some of these kids, essentially, like they're 16, 17, 18 years old, they are the primary breadwinner for their family. Yeah. So I guess I would take back what I said about you should only do it if you're over whatever age.
Yeah.
And that sort of speaks to your point of it's such an individualized situation. If there's someone that's young, but maybe the primary breadwinner for their family, or if their family was dependent on them. And this is, Jay then popped in with the sneaky, all you guys coming in with these last minute questions. I love it. Jay says, can I buy an IUL for my adult child?
Yes, you can. You could buy, yes, you could.
You could buy a policy.
Yes.
So,
yes,
okay.
you can.
Yeah. I'm sorry. I sort of was rambling there a little bit, but it just was interesting to me to start thinking about different people in different phases of their life.
Yeah.
And life insurance isn't not just for old people, I guess is what I'm trying to say.
Yeah, no, definitely not. And I mean, I think even there's a lot of families that I talk to that want to, and I can maybe get into this on a later training, but with the permanent type policies, sometimes people set them up on their kids early enough because really it doesn't get any less expensive to set that up for them at that age, right? So you don't get any younger throughout life. So why not get it when you're the youngest and the healthiest? And even for, like wealthy families, I've studied like the Rockefellers and some of these really, really wealthy families, and it's something that they just automatically do for their kids because they know as a part of their estate plan down the road, they will need that benefit to be able to pay for some of those tax implications or some of those other things. Obviously, that's, again, very individual. Is that going to be for the average, American consumer? Probably not, but you would be surprised even the way that some people are thinking ahead about legacy. And that's why keeping in mind that life cycle, right? When you're doing your financial planning and you're looking at all of your different ways that your money is being invested, looking at legacy at an early age can be something that is hugely beneficial, right? Like as opposed to waiting until super late and when the cost is super high, starting it off early. So it's definitely something to consider, because, that's just the nature of reality. None of us is getting out of here alive, at least at this point, right? Until biotechnology takes over and we live to 200 or 300 years old.
And we're downloading our consciousness on some hard drive somewhere.
Right.
Then until we get that in place, guys, make sure that you're covered, that your family is well cared for. And if you have questions about your specific situation, definitely reach out to Eric. You guys have broached some very intelligent questions here. I'm glad that you're thinking about this. I'm glad you guys are all exploring this. And again, thank you, Eric, for being here with us and for taking us through this training. It was awesome. Thank you so much.
Thank you so much, Rachel. I really appreciate it.
Yeah. Have a great day, everyone. And we'll see you next time.
All right. Take care, guys.